Working as a tax advisor over the years, I discovered a secret. Paying less tax isn't just about using complicated tax structures reserved for the super rich. It's also about doing the simple things that are accessible to anyone. So in this video, I'll share 6 of the easiest ways that you can pay less tax in the UK. Number 1, salary sacrifice. This is where you agree to give up part of your gross income in exchange for certain benefits which you pay for through your company's payroll. So you end up agreeing to a lower salary, but you could end up with more at the end of each month because you're paying less income tax and national insurance. Let me explain how it works. Let's say that Sarah earns £4,500 a month, but she decides not to use her company's salary sacrifice scheme. So that means that she's paying tax on the full £4,500. She's now entered the 40% tax bracket, so part of her income will fall into that higher tax band, and her income tax and national insurance will be around about £1,000 each month. She's decided that she wants private medical cover and a low emissions vehicle, so she'll end up with £2,890 once she's paid for those things. Then let's say that her colleague Ben also earns £4,500, but he decides to use salary sacrifice to pay for the same private healthcare and low emissions vehicle. So he is paying £600 towards that, and he is therefore paying tax on a smaller number. So he actually ends up with more money at the end of each month because he has sacrificed his salary and paid tax on a lower amount. So if you're not already using salary sacrifice, you should definitely consider using it, especially now because more and more people are being dragged into the higher and additional rate tax bands. And that's because of fiscal drag, which basically means that this government and the previous government froze the income tax thresholds. So as people's salaries have increased, more people have been pushed into those higher tax brackets. But by using salary sacrifice, you're ensuring that less of your income is being taxed at those higher amounts. Typically, you can get things like private healthcare cover, cycle to work schemes, and ultra low emissions vehicles through these salary sacrifice schemes. So if you would end up making use of these and paying for them anyway, then definitely make sure that you consider salary sacrifice. Something else that works through salary sacrifice is pension contributions, and we'll talk about that next. Pensions are one of the simplest ways that anyone can reduce their income tax bill. And it works because your pension contributions are deducted from your gross income before your salary is taxed. So say that you're earning £2,500 a month gross, which makes you a basic rate taxpayer. If you don't pay anything into your pension, you'll pay tax on the full £2,500, so you'll pay tax of around £500 a month. If you decide to pay into your pension and you want to pay 10% a month into it, you'll pay £250 into your pension, and your tax will be calculated on £2,250 of income. So that reduces the amount of money that you're paying over to HMRC. So you're now paying £450. Your take-home pay is reduced. It will be £1,800 because you have also put money aside into your pension. So you will have less at the end of each month, but you've actually got £1,800 for today plus £250 for your future self, which has gone into your pension. So you actually end up with more money for yourself at £2,050, and you've paid less money to HMRC. Pensions are also a tax wrapper, which means that so long as your money is invested through your pension, you won't pay any tax on capital gains when you come to sell your investment, and you also won't pay any income tax on dividends and interest that you receive through your investments. Pensions will typically invest in bonds, as an example, and bonds will pay you interest annually. But if you're investing through a pension, you won't pay any income tax on the interest that you receive on that bond. If you'd invested in that bond in a different account, not a tax wrapper, then you would pay income tax on any interest that you receive. So you can see that pensions are very effective for saving tax today, but also for saving tax on any future income and gains that you might might make. Next is the bed and ISA transaction. This is a transaction that enables you to shelter any existing investments from tax using an ISA. So it means that if you've currently got investments that you've made in a regular share dealing account, you would sell those and make sure that they are invested through an ISA if you haven't already maxed out your current annual ISA allowance, which is £20,000. ISAs protect your investments from capital gains tax when you come to sell your investments, and they protect your investments from income tax on any interest and dividends that you receive. So they are an example of a tax wrapper alongside pensions. And this is really important because capital gains tax rates have increased following the most recent budget. So they've gone up from 10% to 18% for basic rate taxpayers and from 20% to 24% for higher and additional rate taxpayers. But by investing through an ISA, you're making sure that you don't need to pay capital gains tax when you come on to sell your investments. So because this transaction involves selling any shares that you currently have in a normal share dealing account, you would have to pay capital gains tax on the sale of those shares. So you would have an immediate tax charge, but you're making sure that you're protecting any future larger gains from tax. The second thing to bear in mind is that when you buy shares through an ISA, you do have to pay stamp duty at 0.5%. So when you came on to rebuy the shares that you've just sold, you will have to pay stamp duty, but it's a very small charge. So say that you were buying back £10,000 worth of shares, that would be just £50 of stamp duty at 0.5%. This type of transaction works with pensions too. So if you haven't maxed out your annual pension allowance, which is usually £60,000, although it can be different for some people, then you would sell any shares that you have in a regular share dealing account and you would buy them back through your pension. So you would again be protecting any future gains and income from tax, but you would also be benefiting from that pension contribution today. So you would have that additional tax benefit. Next, child benefit. If you have children, you can claim child benefit for each child. Some people don't qualify if they earn over a certain threshold. Claiming for child benefit gets you two things. So first of all, you can get money for each child, which is around about £25 a week for your first child, and then around £17 a week for subsequent children. But it also allows you to build up your national insurance credits, which count towards your state pension. And those build up regardless of whether you actually receive the money. So even if you exceed the threshold and you're not entitled to child benefit, by completing the form and making the claim, you can still build up your national insurance credits because you're ensuring that in the future you'll have access to the state pension. It also means that if your circumstances change and you end up earning under the threshold one day, that you're still entitled to the child benefit later down the line. So by claiming child benefit, you're making sure that you receive money for your children when you need it, but it also means that you can qualify for the state pension when you reach pension age. Next is buying rental property through a corporate structure. If you're considering buying a rental property as an investment, then it could make sense to buy it through a company rather than as an individual. And that's because higher and additional rate taxpayers can't deduct the mortgage interest from their rental income when they invest through rental properties as individual landlords. But companies can deduct the mortgage interest that they pay from their rental income. So that's a big tax benefit because it's a write-off that you can claim from the income that your company's making. That's not the case for basic rate taxpayers because they can deduct the cost of their mortgage interest from rental income as individual landlords. So that's why this particularly applies to people who are paying tax at higher rates. But there are a couple of things to think about. So first of all, mortgage rates can be higher for companies rather than individuals, and sometimes it's harder to get a bank to lend to a company to invest in rental property than it is for an individual to get that mortgage. So those things might stop you from investing through a company. The other thing to bear in mind is that when a company makes a profit, the company has to pay corporation tax, and then when you want to extract that money as a director, you have to pay income tax. So there's two layers of taxation when you buy a rental property through a company. But if your mortgage interest is high enough and you are a higher or additional rate taxpayer, then it could make sense to invest in your next rental property through a company. Next, let's talk about gifts. You can make a gift today to reduce your inheritance tax bill in the future. So first of all, you can give away cash gifts. And as long as the person making the gift survives for at least 7 years after making the gift, there won't be any inheritance tax on the cash. There's also no immediate tax charge because cash is not a chargeable asset for capital gains tax, so you don't need to worry about that either. There are certain requirements. So one of those is that that gift of cash can't alter your existing lifestyle. The other thing that you can do is to give away personal property, and these are assets known as chattels, and they include things like antiques and jewelry. So you can give these away free of inheritance tax as long as you don't die within 7 years of making the gift. But with these, there could be an immediate capital gains tax charge if the value of the transfer results in a gain that's larger than the £3,000 annual allowance. So those were 6 simple ways that you can reduce your taxes without the need for any complicated tax planning. I hope you enjoyed the video, and if you did, then please do subscribe to the channel if you haven't already, and I'll see you next time.